Why is Warren Buffett holding over $100 billion in cash while stocks keep hitting record highs? Is he preparing for a crash, or is he waiting for something bigger?
Rates are gravity. If we knew interest rates were going to be zero from now till Judgment Day, you could pay a lot of money for any other asset. You would not want to put your money out at zero. And I would have thought back in 2009 that rates would not be this low 8 years later. But it's been a powerful factor, and the longer it persists, the more people start thinking in terms of something close to the rates they've seen for a long time. So the one thing I'm sure of is that over time, stocks from this level will beat bonds from this level.
Buffett isn't saying stocks are cheap. He's saying low interest rates have inflated asset prices. Investors comparing today's valuations to historical averages may be missing the fact that money has been unusually cheap for years.
If I could be short the 30-year bond at 3% or something and long the S&P 500 and just have it put away for 30 years, stocks are going to far outperform bonds. And the question is, which variable is going to change? And everybody expects interest rates to change, but they've been expecting it quite a while.
This reveals Buffett's long-term optimism. Even while Berkshire is sitting on massive cash reserves, Buffett still believes productive businesses will outperform fixed-income assets over decades.
You're spending billions of dollars, but you still have $100 billion. Is that ideal?
No. We earn very little on it, but that is, we will earn a little more this year on it than but it's just about the world's worst investment, except doing something dumb that you're doing for a longer term. But it does give you the ability to move very quickly if something very big comes along. But I would much rather have that number be 30 billion than 100 billion, and have the other 70 billion invested in, ideally, in businesses we own, but also in securities we own. And we did, for example, put out, I don't know whether it was 12, how much was in the first quarter and how much was in April, I'm not sure. But we put out 15 or so billion net into stocks, and I like that. And it wouldn't, if I could find them and buy them in sufficient quantity, if that had been 50 billion, I'd have been even happier in the first quarter, or if we'd bought a $50 billion business. But you don't want to let money burn a hole in your pocket either. I mean, if we buy a business, we buy it to keep. So if we pay X for a business or 2X for a business, the business doesn't know. It doesn't adapt itself to what I pay. It's going to earn the same. And so if I make a mistake on purchase price, Berkshire Hathaway lives with that mistake.
This reveals Buffett's long-term optimism. Even while Berkshire is sitting on massive cash reserves, Buffett still believes productive businesses will outperform fixed-income assets over decades.
$70 billion worth of equities. We go up every quarter, and we went up a fair amount in the first quarter. No, I would rather own the 170 billion of stocks we have than own treasury bills by a very significant margin. But there are limits to how much I can buy of some of these companies that I like. Usually we quit at 10% almost always.
Most investors fear market downturns. Buffett welcomes them. Why? Because crashes create opportunities. Cash gives Berkshire the ability to act when everyone else is panicking.
Let's talk about Apple, the place where you were spending the bulk of that cash that you were in the first quarter, where you were deploying it. $12 to $13 billion that you put in. That's on top of the, I think, $27 or $28 billion you already, maybe it was $29 billion you already owned in Apple as of the end of the year.
Yeah.
That's a big chunk of that $170 billion. It's the biggest stock that you own by far. It already was before you bought these additional shares, 75 million shares. Why?
Well, I should say, in the past, we had plenty of times when a single stock was a bigger proportion of our total net worth. But in terms of recent times, it was a company I liked a business I liked very much, and we could buy a lot of it. There's some others that are much smaller companies. We just can't buy that much. I might like them equally as well, but I can't put as much money in it. But I clearly like Apple, and we buy them to hold, and we bought about 5% of the company, and I'd love to own 100% of it. But that's the test. Would you like to own 100% of a company? If you're going to buy 5% of it, we're not buying a stock when we buy Apple in our minds. We're buying 5% of a business. We buy 100% of some businesses, and when they're publicly held, we buy 5%. But we bring the same thinking.
This wasn't a trade. Buffett viewed Apple as one of the greatest businesses in the world. Strong brand loyalty, recurring revenue, and a massive ecosystem made Apple exactly the type of company Berkshire loves.
Let's talk about the corporate tax, first of all. Cut corporate taxes from 35% to 20%.
Yeah. Well, if I haven't lost all my friends by now, I'll finish it off. We have a lot of businesses, 60 or 70. I don't think any of them are non-competitive in the world because of the corporate tax rate. I mean, American business earns a return on tangible equity under the present tax system that is extraordinary compared to history, the last 100 years in America. I'm talking about tangible equity, but that's the money you actually invest. You could, and the 5 largest companies in the United States by market value, that's almost 10% of the value of the market, they don't need capital. It is not like the old days where there's big steel companies and auto companies and oil refineries where huge amounts of capital were needed. But we do not, we are among the high earners of the world in terms of return on tangible assets. But if you make it very easy to take back money from jurisdictions in which you pay very low rates, that's going to encourage even more investment over there, because you'd still have a higher rate in the United States. It's American. Listen, on a personal basis, and for Berkshire Hathaway shareholders, I hope they do change it downward. I mean, I would like it in the sense that it would be good for 1 million shareholders of Berkshire in terms of their net returns. But I do think some of the arguments, I think people may find their nose growing a little bit.
The goal isn't to predict what happens tomorrow. The goal is to be ready when opportunity arrives.
Hey, let's talk about the markets again, because you have a long-running bet that's almost up. It's in the final stages, the last year of the bet, about what does better, the S&P 500 index over 10 years or someone who you made a bet with for $1 million who got to go pick 5 hedge funds. He created a fund of funds based on 5 hedge funds. And between the two of you, the S&P 500 index has been the massive outperformer over the 9.5 years of the bet.
Yeah, it'll absolutely kill every one of the fund of funds. And bear in mind, each one of the fund of funds had a strong financial incentive to pick the best funds they could find 10 years ago. I mean, it meant real money to them.
Funds.
Yeah, so it was overwhelming. And passive investment, you know, I've written about it. Passive investment in aggregate is going to beat active investment because of fees.